Welcome to Take Pro Pips, your platform for Forex trading mastery. Today, we'll dive into the vital role of risk management in trading. We'll explore risk allocation, the risk-reward ratio, and the use of stop-loss and take-profit orders. We'll touch on leverage, diversification, and traits of successful traders, discipline, consistency, and learning. Let's get started. Are you aware of the importance of risk management in Forex trading? In the thrilling high-stakes world of Forex trading, risk management is your secret weapon. It's the sturdy lifeboat that keeps you afloat in the turbulent sea of currency fluctuations. Without it, even the most experienced traders can find themselves sinking into the abyss of financial loss. Risk management is the difference between a successful trader, who thrives in the market, and one who loses their capital faster than they can blink. It's the art and science of making calculated decisions, of knowing when to hold your ground and when to fold. It's about not putting all your eggs in one basket, but spreading them out, diversifying your investments to minimize potential damage. And most importantly, it's about understanding that the market is unpredictable, but your actions don't have to be. Mastering risk management can elevate your trading game to new heights. How much of your trading account should you risk on a single trade? This is a question that every trader, whether newbie or seasoned, grapples with. The answer? Well, it's not a one-size-fits-all, but there's a general consensus among successful traders that you should risk only a modest portion of your account on any single trade. Usually this fraction ranges between 1 to 2%. Why such a small amount, you may ask? The key reason is that it helps you stay in the game longer. Let's face it, not every trade will be a winner. By risking a small percentage, you ensure that a losing trade doesn't wipe out your account. This way, you live to trade another day, even after a string of losses. So the next time you're about to enter a trade, ask yourself, am I risking more than 1 to 2% of my account on this? If the answer is yes, you might want to reconsider. Remember, longevity in trading comes from prudent risk management. Have you ever heard about the risk-reward ratio? It's a concept that should be ingrained in every trader's strategy, and here's why. The risk-reward ratio is a measure of the potential profit you stand to gain on a trade relative to what you could lose. Now let's take a moment to think about this. If you're aiming for a ratio of 1 to 2, that means for every dollar you risk, you're aiming to gain 2. That's a pretty good deal, right? And it's not just about the potential for profit, it's about ensuring your trading strategy is sustainable over the long haul. Imagine you're on a losing streak. With a 1 to 2 risk-reward ratio, you could lose half of your trades and still break even. That's because your wins are twice as big as your losses. It's a buffer, a safety net, a way to keep you in the game even when the going gets tough. A smart risk-reward ratio can be your path to profitable trading. Let's talk about two essential tools in managing risk: stop-loss and take-profit orders. Picture this. You're in a high-stakes poker game. Stop-loss is your friend who taps your shoulder when you've lost enough and need to fold. It's an order placed with a broker to sell a security when it reaches a certain price, limiting your potential losses. On the other hand, take-profit is like your friend who nudges you to cash in your chips when you're riding high. It's an order that closes your trade once it reaches a certain level of profit. So, even if the market suddenly shifts, you've locked in those gains. Both these tools provide a safety net, allowing you to manage your risk and protect your capital. They help you stick to your trading plan, making decisions based on strategy, not emotion. Remember, the key to successful trading isn't just about making profits, but also about smartly limiting losses. Stop-loss and take-profit orders, your guardians in the risky world of Forex trading. Leverage and diversification, two powerful yet risky strategies. Let's begin with leverage, a tool that can magnify your profits but also your losses. It's like a double-edged sword, increasing your buying power, but also amplifying the risk. The key is to use leverage sparingly and wisely. It's not about how much you can borrow, but about how much you can afford to lose. Now, on to diversification. It's essentially not putting all your eggs in one basket. By spreading your capital across different currency pairs and markets, you reduce the risk of a single event wiping out your investment. Think of it as balancing your portfolio. So if one currency pair falls, another might rise, cushioning the blow. Remember, effective risk management isn't just about one strategy, it's about combining these tools. Understanding risk per trade, setting a risk-reward ratio, using stop-loss and take-profit orders, leveraging wisely, and diversifying your portfolio. Use leverage wisely and diversify to spread your risk. Discipline, consistency, and continuous learning, the holy trinity of successful trading. These are not merely words, but guiding principles for every trader aiming to navigate the choppy waters of Forex trading. Let's start with discipline. It is the bedrock of your trading journey. You see, a solid trading plan is only as good as your ability to stick to it. It requires discipline to resist the allure of quick wins and adhere to your risk management strategies. Next, consistency. This is about making your successful trades a rule, not an exception. By consistently applying your strategies, you can create a reliable pattern of success, reducing the impact of inevitable losses. Lastly, continuous learning. The market is an ever-changing beast. It demands constant vigilance, ongoing education, and a willingness to adapt. It's about staying updated on market conditions, learning from your trades, and adjusting your strategies accordingly. Stick to your plan, stay disciplined, and never stop learning. Ever tried perfecting your risk management strategies in a risk-free environment? Well, that's where demo accounts come in handy. These accounts offer you the luxury of trading in Forex without the fear of losing a single dime of your hard-earned money. It's like a sandbox, a place for you to experiment, learn, and understand how different strategies work in various market conditions. Think of it as a flight simulator for pilots, where they can make mistakes and learn from them without the risk of crashing a real plane. Similarly, a demo account allows you to make mistakes in your trading and learn valuable lessons without the fear of actual financial loss. It's a place where you can apply everything we've discussed so far: risk per trade, risk-reward ratio, stop-loss and take-profit orders, leverage, diversification, and your trading plan, all without risking your capital. So, the takeaway? Use demo accounts to practice, learn, and fine-tune your risk management strategies before risking your hard-earned money. Because in Forex trading, knowledge is power, practice makes perfect. Wrap up. Like the video, subscribe, and hit the notification bell for more Forex trading insights. Happy trading!